Hey, it's Mark Ferguson with Invest for More, and we're back with another real estate video. Today we're talking about mortgages, which is something everybody should know about. Whether you're an investor, a homeowner, a renter, maybe someday you're thinking about getting a mortgage, it's really good to know how they work. Mortgages can be a huge financial wealth building tool because of the way they're structured, how they can increase leverage, and with rates so incredibly low right now. So this is part one of a part two series because they're kind of long videos, so make sure you subscribe to get notices when part two comes out. It will be very quick. It's already mostly shot. And then of course, like, and we'd love to hear your comments too if you have questions or think I messed something up. So we'll talk about how a mortgage works, how a payment is calculated, how amortization works, what part's principal, what part's interest, if mortgages are front-loaded or not, how all of that works. Why do we have 30-year loans? An interesting story on how they came about, stemming from the Great Depression. So we'll talk about that. And of course, how much the payment would be on a $100,000 loan, how much is paid off over a certain amount of time, how all that works. Now, if you have a more expensive loan, which a lot of us do, just multiply it by whatever you need to. The numbers will stay the same. All right, we'll get right into it. Of course, check out investformore.com for much more information on flips, rentals, being an agent, all of that great stuff as well. And I have a full article written out on all of this as well, if you'd like to see it in writing, that we'll link to below. So make sure you click on that link if you want to read about what we're talking about here. All right, let's get started. So I want to start off real quick on just the history of mortgages in the United States and how they came about a little bit and why we have them. One of the big reasons mortgages as they are today came about was the Great Depression. So there was a huge real estate crash before the Great Depression, and some people argue that may have caused it, not the stock market crash, especially in Florida, where it's just crazy speculation, ridiculous lending, and people would usually have 5 to 7 year loans they'd have to refinance over and over again, because after 5 years, the bank could call it due, they have to refinance it, and that actually made it much worse if property prices went down, if you got in trouble, because you might not be able to refinance after 5 years, and then you get foreclosed on, you lose your house. So after the Great Depression, 30-year mortgages came about where you can get a loan that you pay off over 30 years, and with the vast majority of them, especially owner-occupant loans, the bank can't just come call it due, or they can't tell you have to pay it in full after 5 years. If you make your payments, you've got 30 years to pay that off. Now you can always sell it, you can refinance it, but it made it much safer to buy a house and much less risky and reduced foreclosure. So some people think 30-year loans cause more foreclosures. It's actually the opposite. They actually help their decrease foreclosures because they're such a long-term loan, and they have lower payments too. So if you do get into problems, it's easier to get through on a lower payment than a higher payment. And we'll talk a little bit about that later too. Also, mortgages help more people buy houses. FHA came into effect, the Federal Housing Administration. The more people who buy houses, the better it is for the economy. So that's why real estate has so many tax breaks, why the government is always trying to get people to buy real estate. And right now, I think 67% of households own a home, which is the highest it's ever been, except right before the last crash. I think it got close to 70, but that was mostly due to horrible lending guidelines. Now, a lot of people are owning homes based on some of the strictest guidelines ever. So even though housing is getting more expensive, it's not out of reach for most people. Most people actually own a home. And another stat that is really cool is people say, yeah, but 30-year loan is a wealth killer. You spend all this money on interest. I think the stat is 66% of Americans have their net worth in their home. So the vast majority of people make most of their money from their house. So a house is actually an amazing investment for most people, even if they don't know what they're doing. I have a really long in-depth video on that I'll link to, whether it's better to buy or rent a house. For most people, it is so much better to buy a house and rent it for tax advantages, leverage, forced savings, all kinds of reasons. And I go into those details in that video. We won't do that here. But now let's talk about how a mortgage is formed and how it works. All right, so a lot of people think a mortgage is front-loaded with interest, which means all my interest is paid up front. The more I pay off now, the less I'll pay off later, the better it will be. And that's true, but not because the loan is front-loaded. It's simply because you have a lower loan balance. The more you pay off, the less interest you pay because the loan balance is lower. So here's how a mortgage works. We're going to use $100,000 because that is easiest for math. Interest rates right now are really low, but we're also going to use 5% interest rate just because that's even really, really low historically, but that seems like crazy high right now. So if you have a $100,000 mortgage with a 5% interest rate, you're going to be paying 5% of that $100,000 per year in interest. So what is that? I said easy math. $5,000. So you pay $5,000 a year in interest, and then each month you divide that by 12, $416.16. That math I did not do in my head. I had to cut out and figure that one out. That's what you pay per month in interest on $100,000. Now, a mortgage is amortized, which means you pay it off over time. So you can have a 15-year, a 30-year loan, and the amortization schedule is what creates your total payment. So this is just interest right here. And then you also have a principal portion. You're going to pay this amount is always going to be 5% of whatever your loan balance is. It's not front loaded, it doesn't change. It's always 5% on a fixed rate mortgage. So if this goes down to $90,000, then this is reduced. If it goes down to $50,000, this is reduced to 5% of whatever that loan is, and you're always paying that amount on the money borrowed. The difference in your payment comes in the principal, how much you're paying off. For example, on a 30-year loan, your principal is going to be $120 here, making your payment, I have my numbers, $536 total. Now you have taxes and insurance that are escrowed, and that we'll talk about later too, but basically you pay property taxes and insurance, and it's bundled into your payment. So your lender wants to make sure you're always paying those because they don't want the house to burn down or get repossessed from the government and they get stuck with the loan. But we're just talking about the principal and interest for now. So that number changes based on the amortization schedule. This is a 30-year loan. If we do a 15-year loan, this jumps up to $374, and your payment is $790 total. So the difference between a 15 and a 30-year loan, the interest rate can be a little lower. You might pay like 4.5% on the 15-year loan, so that would reduce the interest slightly. But what you're really doing is you're paying way more principal than on the 15-year loan than the 30-year loan. And that's why it reduces your interest you pay over time because you pay it off sooner. This amount is less. But I prefer 30-year loans, and I'll talk about that, and I do in another video, but it's much better to have a long-term loan, in my opinion, and invest that money and have that difference. So we'll look at some of these differences here in interest rates too to show you how a different interest rate affects that as well. All right, so numbers can get a little confusing, but I made this kind of chart to hopefully make it a little clearer on what the differences might look like and how interest is impacted by different loans. So here's a 5% interest rate, 30-year loan. Your principal you pay down the first month is $120. That increases every month because you're paying down the loan over time. The interest you're paying is $416. Your total payment, $536. If you have a 15-year loan, I fixed the rate, you'll probably have like a 4.5% rate. This is assuming rates are much higher than they are now. Don't worry, I lowered them. Your principal you're paying is $374. That's why a 15-year loan has a higher payment and you pay it off so much faster because you're paying so much more every month in principal. Your interest is lower. It's lower because of the lower rate, but your payment is still much higher, $764. So you have a $228 higher payment every month, which may not seem like a lot, but over time it adds up to a lot of money. And I would rather invest that money and make 15% or whatever I do on real estate instead of pay off a 4.5% loan. That's my ideas. Now, interest rates are even lower, makes even more sense not to pay those loans off earlier or faster. So let's say we have a 30-year loan at 3% rate, which is closer to what rates are today. $171 you're paying in principal and $250 you're paying in interest. Your payment is $421. That's so crazy. You're paying $400 for a $100,000 loan. And what's interesting too is as rates go down, your principal goes up. Even though your payment is lower, you're paying off more every month because that interest is so much lower. And then with a 15-year loan, we'll say the rate's 2.5%, you're paying $458 in principal and $208 in interest every month. Again, this interest is lower because your rate's lower, but you're paying way more principal to get that loan paid down. So in fact, your payment's $669 with the rate lower, and it's really not a huge difference between those two numbers. Because the 15-year loan is trying to pay it off, you're paying much more over time in principal. All right, so we talked about how the different rates and terms affect your payment. One other thing I wanted to add in here real quick. After 5 years of paying down the loan, here's what your new principal and interest will look like. Your payment's going to stay the same. It's not going to change. But for the 30-year loan, you're now paying $198 towards principal, so that's gone up, and $222 to interest. That's gone down. So as you pay the loan off, your interest goes down while your principal payment goes up. So you're paying off the loan more. And then with the 15-year loan, after 5 years, you're now paying $505 towards principal and $161 in interest. So again, with the 15-year loan, you do pay less in interest. That's not disputable. The big difference is you're paying so much more in principal, and your payment is so much higher. And for me, I'd much rather pay a lower payment, invest that difference and make more money than pay off a 2.5% loan. If you can make more than 2.5% investing, you're better off not paying it off early, not paying that off, or 3% if you're getting the 30-year loan. You're better off investing that money instead. And this doesn't seem like a lot now, but if you add it up over 5 years or 60 months, right, that's $248 times 60, which is a lot of money that you could be investing instead of paying off the mortgage. All right, so we've talked about a lot of different costs and been all over the place with numbers, but here's kind of a breakdown of what your total payment would be on a $100,000 loan. So again, obviously if you're buying a more expensive house, which many of you will do in today's market, you would increase these costs at 3% interest. We're going to use 3% because that's closest to today's rates. Your PI, principal and interest, is $421. So if you hear PITI, that's principal, interest, taxes, and insurance. So if you hear PITI, that term, that's all of these together. So you've got that. Your property taxes might be $100 a month. They might be $200. They might be $50. It varies in each state. They can vary greatly. So that's something to consider as well, how much your taxes will be. Your insurance might be $100 a month. It might be $50. It might be $200. Again, that varies depending on the location you're in as well. You might need flood insurance in a flood zone. That can increase that cost a lot. And your mortgage insurance, we just put $80. So a typical all-in payment for a low money down mortgage of $100,000 could be $700 a month. Pretty affordable. It's usually going to be less than rent, even when you consider all of these other costs. And people say, well, what about utilities? Well, you pay utilities when you rent a house too. So those will be there too. What about maintenance and repairs? Well, when you make maintenance or repairs on a house, it often raises the value of the house. It's not just a lost cost. So that's an advantage as well as when buying. And plus, a big chunk of this is going towards your principal pay down. So this isn't all a lost cost either. This is tax deductible. Your interest is tax deductible. Some of these may or may not be tax deductible, usually not. But you also have amazing tax advantage if you're itemizing your taxes. So there's some amazing tax advantages when buying a house too. Not to mention if you live there 2 out of 5 years and then sell the house, the profit is usually tax-free up to $250,000 for an individual or $500,000 for a couple. So I don't know of any other government program that lets you have a tax-free profit, not tax-deferred, tax-free. No exchange, you don't have to do anything with that money, it's tax-free. So some of the reasons why buying a house is great, even though I know we're talking about mortgages, I get off on this tangent sometimes, so sorry about that. All right, thanks for watching. Really appreciate all the support and likes and comments and new subscribers. Welcome to our channel. Like I said, there's gonna be a part 2 that goes more into the types of mortgages, how much money you need to have a mortgage, how to put less money down with mortgages, which you can do. There's so many different things that you can do to buy a house. A lot of people don't realize how affordable it can be. And there's a growing sentiment that buying a house is a bad thing. The vast majority of people are making good investments when they buy houses for savings. It's a massive use of leverage. And even if things go wrong, you probably get to live in a house for free for years, because the average time to foreclose on a house is 700 days in the United States, and you don't have to make a payment when a house forecloses. So that's worst case scenario. We're not encouraging people to do that, but if everything goes bad, owning a house is usually better than renting and being evicted in a couple months. So make sure you check out the next video coming up, and of course check out investformore.com. And we've got books on Amazon as well if you really want to dig into this and learn how it all works, including my How to Buy a House book, which goes over the basics on buying a house. All right, thanks for watching. We'll be back soon.